Right, guys, taking a quick look then at the Aussie as we turn our attention to the upcoming RBA policy decision, which will be one of our main focus points for this week ahead. Now, recall back in the December meeting, the RBA explained to us that they are going to decide on the future of their current bond purchase program, their QE program, and they will consider three very important criteria for them to be making that type of decision. The decisions that they, or criteria that they will be looking at, firstly, is the actions of other central banks. Secondly, how the Australian bond market is functioning. And of course, most importantly, the actual and expected progress towards the goals of full employment and inflation consistent with the bank's target. So let's take a look at all three of these things separately. The first one is the actions of other central banks. Now, it's pretty clear that, in our opinion, this box has been checked quite some time ago. The RBNZ hiked twice in 2021. They're expected to hike another 5 or 6 times. The Bank of England hiked in December. They're expected to hike again this upcoming week as well. The BOC held off on a hike last week, but they are expected to follow through with one in March. And when it comes to the Federal Reserve, this chart that we're looking at speaks volumes of how hawkish the bank has pivoted, with the Fed fund futures now implying close to 5 hikes for the Fed by the end of 2022. So the markets usually assume that major central banks like the RBA, they don't want to be too far ahead or too far behind the Fed when they do make a policy move. And with that in mind, the RBA, if they were concerned about staying behind the Fed, I think they have nothing left to worry about. With the RBNZ moving, the BOC potentially moving in March, the Bank of England already moving, the Fed expected to move in March as well. And we think that box has been firmly checked in terms of the actions for other central banks. Now, the other criteria that they will be looking at, of course, is the bond market. Now, if we take a look at the recent bond market functioning on this chart, on the left-hand side, we've got the Aussie 10 versus the Gilt 10-year, Canadian 10-year, US 10-year. On the right-hand side, we've got the twos. Now, we can see that despite that big pop we had to the upside a little bit earlier last year, it's been fairly calm in a bond market point of view. We haven't seen any dysfunctional moves like we saw back in November last year. And apart from that, we've seen these bond yields moving very much in line with the other major economy bond yields as well. So on that front, we haven't seen any dysfunctional moves, and on that front, we think that also check marks the bond market functioning box that the RBA will be looking at. The other one that they will be focused on, and they have said that this is going to be the most important one, is the progress towards their economic goals. Have they made progress towards their inflation as well as their labor market goals? Now, if we just take a look at some of these recent data points, we think this firmly marks the box as well. If we take a look at the labor market, we saw the unemployment rate dropping to 4.2%, way below the market's expectations and minimum expectations in that January print that we had for December. That's coming in at a 13-year low right now, if I recall correctly. So very low number there. In terms of the inflation outlook, if we take a look at year-over-year headline, we came in at 3.5%. So that's way above the bank's target band of between 2 and 3%. If we take a look at those core measures, that weighted median and trim median, both of those is now above the middle of that target range, above 2.5% basically. So from a data point of view, we think that this shows that there has been substantial progress made towards their goals. Both of these types of levels, whether we're talking about inflation or the unemployment rate, was only expected to occur much later towards the end of the year. So the fact that we've gotten that now has been a big jump. The one blemish, though, to just mention here is the fact that the recent flash CPI or PMI data, rather, for January came in very low. If we take a look at the prior for the services, that was 55. We came in at 45. For the comp, prior was 54. We came in at 45. So that's a very big miss. And that is, steeply into contractionary territory right now. Now, there is a chance that this merely reflects some of the preliminary impact from the Omicron variant. But of course, this will be something that the RBA no doubt would have noticed. And it is one of the blemishes in terms of, the incoming data, at least on a CPI as well as an employment point of view. There's been plenty of progress made. Now, what have been some of the other positive factors that we think the bank will be looking at? Well, when we consider terms of trade, there's two really, really important commodities for Australia's economy. That's coal and, of course, iron ore. The two of those make up the bulk of Australia's exports and, of course, the bulk of exports to China. So the fact that the PBOC has recently upped their support for the economy, bringing new easing measures, adding more stimulus, that has seen quite a healthy pop to the upside in both coal prices as well as iron ore prices. And we do think as long as these remain intact, that should be a positive driver for the Australian dollar. The one thing just to keep in mind, though, is that China did last week say that they are stepping up efforts to try and bring more calm to these types of prices, to these commodity prices. So being key imports, we do need to just be mindful of any potential efforts from China to try and bring these prices down. So what are the things that could potentially hold the RBA back from turning more hawkish, or let's say less dovish? Well, one of those things, firstly, is coming back to the inflation story. Even though we do think that looking at that target band, there's been a lot of progress made in a very, very short space of time. Even though the RBA should be happy about that, the one thing that the RBA is always very, very focused on is wage growth. Where's wage growth at? Now, the most recent wage growth reading going back to November came in at 2.2%. So we are still, fairly far away, 0.8% away from the RBA's, magical 3% wage growth number that they're looking for. Right now, the only time, or the next time that we'll get this print will only be the 23rd of February. So, the bank could potentially, if they really wanted to still lean dovishly, they could lean on the fact that they still want to see what that new wage index prints at the end of February. If they do that, obviously that'll be seen as a dovish tilt. If they use that as a reason not to move away from quantitative easing, that'll certainly be seen as a very dovish tilt from the bank. But that is a possible thing that could, that the bank could use, that could hold them back on announcing a possible end to their quantitative easing program. Now, going into the week, expectations right now, consensus expects the RBA to pivot away from their quantitative easing program to announce an official end of their QE program. Remember, right now they're still buying 4 billion Aussie dollars worth every week, and the expectations are for them to announce a complete closure or end to that program. So that is what consensus are expecting. Apart from that, the markets will be looking at any type of language change from the bank. Remember, last time, if we take a look at the statement, the last time they said that they still expect hikes much later than the markets were pricing in, but they did drop some of their language in terms of only looking for hikes all the way out into 2024. So this time around, the markets will be looking for any potential signal that maybe sooner hikes is on the table right now. Also, if they come out soon, sounding a little bit more concerned about inflation, that will be a key focus point. Remember, they've been fairly sanguine with the inflation outlook in terms of not expecting a blowout numbers to occur. And the recent prints have certainly been much higher than they anticipated. So looking at any type of more concern from them on the inflation front will also be seen as a positive. And then, of course, if they downplay the recent PMI data and stick to the more optimistic tone about the overall recovery expectations, that should be a positive as well. But from an expectations point of view, markets are looking for them to scrap the QE program. So if they do come out and they don't scrap the QE program, potentially only tapering, let's say, half of that, continuing with 2 billion maybe until May, that will be seen as a hawkish tilt. Obviously not what the markets are expecting right now, but certainly a possibility that we do need to keep in mind. Now, because consensus expects them to announce the QE program, that will be the first area of focus for the markets. And even though this is largely expected, we do still think that there could be some upside for the Aussie on the back of that. And the reason for that comes down to positioning. Right now, the Aussie is still sitting on the biggest net short position among the major currencies. It's at all-time lows for net shorts, at negative, over negative 80,000 contracts. So even if the RBA announces an end of quantitative easing, and that is expected by the markets, it could still be enough to spark some unwind of those net short positions and still prove supportive for the Aussie dollar. Also, we need to consider what has been priced for the RBA. If we take a look at Stir futures are currently pricing in close to 5 hikes this year for the RBA, which is of course way too aggressive for what we think the bank will be able to deliver. That doesn't mean that the markets won't care if the bank turns less dovish, though. Remember that the big difference between what the markets have priced in for the RBA and what's been priced in for the likes of the RBNZ or the Bank of England or the Bank of Canada or the Fed is that the RBA still actually needs to tilt away from a dovish policy. The other banks have all confirmed their hawkish stance. They've all hiked or moved towards hiking, while the RBA still needs to shift away. So even though the markets have priced in a lot for the RBA, we do think there's a lot of surprise potential if they finally do confirm a little bit more of a hawkish tilt that the markets have been anticipating. Furthermore, if we compare the recent moves to what we've seen in the Aussie dollar compared to the economic data that we've had, compared to the moves that we've seen in the bond yields, there is arguably a lot of catch-up potential to the upside for the Aussie dollar right now. That means that if we do see an as expected and it's just a move away from quantitative easing, we do think there is catch-up potential for the Aussie dollar to catch up to what's already been priced into stir markets and, of course, what's been priced into bond markets. Our main focus points going into this meeting will be 4 things. We're looking for them to announce an end of the quantitative easing program. Even though that is expected, we are expecting that to be positive for the Aussie, given the positioning as well as the lack of pricing in positives compared to the likes of stir markets and the bond market. Apart from that, if they drop their language of some time, i.e., signaling that sooner hikes is possible, that is obviously expected to be positive. If they sound more concerned about the rising inflation compared to their December meeting, and of course, if they don't sound too worried about the softer PMI data, if they say that it's mostly Omicron, but they're still very optimistic about the recovery, all of that is expected to be positive tilts and something that we'll be looking for some potential upside in both the Aussie Kiwi as well as the Aussie CAD. The reason why we chose the Aussie Kiwi and the CAD, firstly, we think there's a lot of catch-up potential, like we explained. Apart from that, given the recent negative risk tones we've had in the markets, the stress we've seen in equities, we want to be just a little bit more isolated from risk sensitivity. So the fact that we've chosen to trade a high beta versus 2 other high betas just makes a little bit more sense right now in the current context that we're trading. Now, as always, the other thing to focus on will be the Aussie dollar. Even though all 3 of these are high betas, the Aussie is a favorite risk proxy. So strong risk off tones normally does tend to weigh a little bit more on the Aussie. But for the same, the other argument is also true. And that means that if we do see a more positive risk sentiment develop, that should also potentially be more positive for the Aussie as well. Again, since positioning is so stretched, we would prefer to only trade a hawkish surprise from this RBA as opposed to trading a dovish surprise, even though a dovish surprise can, of course, still push the Aussie dollar lower. With where positioning is right now, we think that the easier trade, the path of least resistance would be to the upside if we see a reason for net shorts to be squeezed out a little bit by a hawkish tilt. If it's a dovish tilt, we'll just stay patient with the Aussie in the week ahead. So hope that helps with your scenario planning, guys. And as always, good luck out there. Any questions, don't hesitate to let us know.